COSO Enterprise Risk Management Framework, or sometimes called the COSO ERM framework, Enterprise Risk Management. First of all, this model is just for your guidance. This model doesn't have the force of the law. Just like COSO Internal Control in CMA Part 1, most of you have done Part 1. Same thing is COSO ERM is just a thought leadership for you, just a guidance. It's not a mandatory requirement that you should follow COSO ERM. But nonetheless, COSO, I hope most of you would know, it stands for Committee of Sponsoring Organization of the Treadway Commission. It is composed of 5 accountancy bodies in the US: Institute of Internal Auditors, Institute of Certified American CPS, American Institute of Certified Public Accountants, Institute of Management Accountants, what we're doing, CMA, AAA, American Accounting Association, and FEI, that is Financial Executive International. These are the 5 bodies that have sponsored COSO, and they only provide guidance and thought leadership. Their pronouncements are not to be followed like law. They do not have the force of the law. They just provide you the guidance, only for your guidance. So surely your choice whether you would like to follow the pronouncements or don't. So let us just first discuss some key terminologies of COSO ERM, and then we go into the model. First, what is risk? We have already discussed risk, any unforeseen event that might prevent an organization from achieving its objective. How does ERM defines it? Any possibility or event that will occur and it will affect the achievement of strategy and business objective, or anything that will prevent or hinder an achievement of business objectives called risk. Fine. Then what about next term, values? We need to learn the main terms well, then we can move on. Values means beliefs in an organization. Every organization has some value system. What they value: quality, profitability, customer satisfaction, providing a reliable product, so on and so forth. Beliefs in the organization that defines our action, how we behave, how we act. Culture. Culture is hard to define, but it's a collection of your attitudes, your behaviors, and your understanding about risk. Some business have macho culture, they are ready to take on risks. Some cultures are more or less like bureaucratic, where they weigh and see cost versus benefit and then take the decision. So culture, attitudes, behaviors, understanding about risk, how we respond to risk. Your culture defines our behavior against risk, our attitude toward risk. Fine, makes sense. Mission, we have been studying what is mission. Mission is why does a business exist? It's a rationale behind the existence of the business. It's the purpose why a business exists. Mission statement, the core purpose. Why do we exist? For what? What about vision? Where do we see ourselves in the future? Aspirations. Vision is the organization's aspirations for what it intends to achieve over time. What do we want to do over time? That's what you call the vision. Makes sense? Then we just discussed values, the beliefs in an organization. Then another term, more refined, core values. Core values are the essential beliefs. Core values are the essential beliefs in an organization. What is acceptable or what is unacceptable. Core values. Capabilities. We are doing key terms first. Capabilities are the skills needed to carry out the entity's mission and vision. The skills the management should have so that the organization's main objective could be met, so that the organization's aspirations could be met. Makes sense? Common understanding as per our business acumen. Practices. Practices are the collective methods we use to manage risk. How would you manage risk? We will discuss there are different risk responses depending upon our cost-benefit analysis. We'll see. So practices are the collective methods we use to manage risk. How do we respond to risk? Then strategy, we know the word. In our common everyday use, strategy means the way of doing something, right? But how do we view strategy in the risk management, ERM? Strategy informs how the organization will achieve its mission and vision. How would you achieve your goals? The way of action, and how it intends to apply its core values. What are core values? Your essential beliefs about what is acceptable, what is unacceptable, and all this, ladies and gentlemen, from the point of view of risk management. Making sense? We are making just first understanding of the key terms. Then we have the business objectives. Business objectives are the steps to achieve the overall strategy through which we can achieve our mission statement. Remember, business steps, objectives are small steps taken together so that we can achieve our long-term goals, our mission, our vision. So business objectives are the steps so as we can achieve our mission and vision. Next, tolerance from our everyday use. But what about tolerance with regard to enterprise risk management? Tolerance means, let me explain with the help of this risk profile. We'll discuss it later. Let me explain that. On the x-axis, we have performance. And on the y-axis, we have a risk, right? If we want more performance, better returns, we need to take more risk. That's what we have done so far. Performance and risk, they are positively correlated. High performance would result in higher risk and vice versa. So this is so. So this would show an increasing, a curve that is with the increasing slope. Makes sense. Then what about this thick line? This thick line means that you have a specific risk you are willing to take. Risk appetite we discussed previously is the risk the business is willing to take. So we don't want to go beyond this risk. This is our limit. We want our performance, but we don't want to go beyond this. What we are studying is risk profile. So this is the line indicating the performance and risk, they are positively correlated. This is the risk we are willing to take, that's the risk appetite. Now listen, our results should fall between these two upper and lower limits. Our performance should be between this lowest and this upper end. This is what you call the tolerance. This is the tolerance line. I mean, this is the minimum level of performance and this is the maximum. Our performance should fall within this band, within this tolerance. That's what it means here, right? So we will discuss the remaining part as we go along. Right now, tolerance means the risk, the range of acceptable variance in performance, that the minimum and maximum performance within the given time frame, right? So that's just for this, explaining this concept here, is the range of acceptable variation in performance, minimum to maximum. Risk profile, this is what you call risk profile. The trade-off between performance and risk. So risk profile is an evaluation of an individual's willingness and ability to take risk for an individual or for an organization as a whole. Portfolio view, yes, this is important. The major difference between the previous approach to risk management and the ERM, enterprise risk management, is that previously the risks were managed individually one by one. What's the risk related to cash, inventory, and we had each response for each type of risk. Risk management was compartmentalized. It was in silos. Every different risk in every department was managed differently. But in ERM, we go for an integrated approach to risk management. This is the difference between the conventional risk management, where we follow a compartmentalized approach, to an integrated approach where we take the enterprise as a whole, and risk management is considered as an enterprise level activity, not a departmental activity. This is what you call the portfolio view. So what is portfolio view? Quickly, it's a composite, it's a combined view of the risks related to entity-wide strategy, the overall entity as a whole, not just a single department, right? For the whole entity, for the whole entity's performance. So this is the view of risk under the enterprise, COSO enterprise risk management. Then the next key term is opportunity. Opportunity means any potential action that creates or alter goals or approaches for the creation, preservation, and realization of value. There are many, many terms discussed within this explanation. We are going to discuss what is the value creation, value preservation, and value realization. So we'll come up to this term later on. Let us first discuss the relevant terms later on. Opportunity will come later, because these terms needs to be explained. What is value? Okay, let me explain it right here so that you just understand it right at this point. Value, first of all, what is value? Value means any benefit created by the organization for different stakeholders. For shareholders, it's profit, dividends. For employees, job security, better working environment. For management, reward for their efforts, appreciation, recommendations, so on. So value means benefit for the stakeholders. Organization should create benefit for the shareholders, right? Then what is value creation? Value creation means creating benefit for the shareholders, benefit for the different stakeholders. Value preservation means protecting the value of resources. When the use of resources is sustained, you make good use of your resources. That's how the value is preserved. Value creation, creation of benefits. Value preservations mean better uses of resources, and realization of value means when the benefits are transferred to the stakeholders, dividend to the shareholders, timely payments to the bankers and the fund providers, and the right amounts of wages to the employees. That's what you call the value realization. Now let us read the whole topic now. Opportunity means any action by the management or by the person involved that creates or alters goals or approaches for creation of value, preservation of value, or realization of value. Anything good, that is an opportunity that creates value, preserve values, or realizes the value. We'll discuss these in detail later on. Next, risk inventory. Let's say if you are working in a bank and you are in the compliance department, so you would know what kind of risks you may face in the compliance. This A, B, C, D, E. All the risks you may have faced over the last few years or last 10 years, all these risks identified, what you may have faced, this is called the risk inventory. It consists of all identified risks that affect strategy and business objective. So they might come from your past observations, or you may have identified them while studying your business operations or specific part of the business. So risk inventory, just like the inventory of your material, risk inventory are the identified risks that can affect your business objectives and strategy. Okay. Risk capacity. Risk capacity is the maximum amount of risk the organization can assume. Let's say an organization can take a risk of $100,000, but it is only willing to take a risk of $30,000. This is the capacity that you can take, but this is what you actually take. This is the difference between risk capacity and risk appetite. You can take on a risk of $100,000, but you are just taking risk of 30. So this is your risk capacity, and this is the risk that you are willing and accept in the pursuit of value. Right? So that's the difference between how much risk you can take and how much risk you are willing to take. Okay, then inherent risk, we discussed this in our previous lecture on risk management. Inherent risks are the risk absence of management and action. Let's say there's a gold in your warehouse and management does nothing. There are no closed circuit TV cameras, there are no one watching. So the risk to the gold, which is quite apparent, is highly desirable metal, precious metal, it will be stolen. So inherent risk is the risk in the absence of management actions. If management doesn't take any action, the whole of it will be stolen, maybe by your own employees. So when there is no management action, the risk that stays is called the inherent risk. You need to take some action, some controls, some closed circuit TV cameras, some guards, some check and balances. So inherent risk is the risk that arises from the nature of the business itself. If management doesn't take any step, the risk that arises from the nature of the business itself is called the inherent risk. So these pieces of gold are more inherently risky to hold than the pieces of wood. No one would like to steal wood, clearly. Okay. Next, we discussed this concept already. Residual risk, the risk that remains after taking all the steps you can take. Some of the risks you have avoided, some of the risk you have transferred, some of the risk you have reduced. The risk that doesn't go away is called the residual risk. Now, what is the actual residual risk? Actual residual risk means the risk remains after management action to alter its severity. Management has taken some step, So the risk that you actually face after taking different steps is called the actual residual risk. Risk response, we know. We know some risk can be exploited. Some of the risk can be accepted, called risk insurance, self-insurance. Some of the risks are mitigated. Some of the risks are shared. And some of the risks are avoided. There are 5 responses. We will discuss these. These are risk responses. So risk responses are the actions taken by the management within the organization risk appetite. Our appetite, our willingness to take risk will dictate that we should exploit some risk, we should accept some risk, avoid some risk, mitigate some risk, and share some risk. So what you should do depends upon how much risk you're willing to take, and then your responses will follow after the risk appetite has been discussed. Then the target residual risk. We discussed this, the risk that remains after taking some steps to reduce their severity. So we may have, this is the target. Let me take you back to that slide. I think I have it in the next slide. No, need to go back. Not here. Okay, let's move on. Okay, now let's say this is this line represents the target residual risk. This is what we expect the residual risk to be after taking certain steps. Your actual residual risk might be less or might be more than the target, depending upon the actions you have taken to manage the risk. So target residual risk is the risk that the entity prefers to assume, knowing that the management has acted or will act upon it to alter its severity. Management takes some steps to alter the severity by doing what? By either exploiting or avoiding, or by mitigating, or by sharing. There are different ways we'll do. So by altering its severity, your target risk is what you want, but the actual residual risk might be more or less than the target residual risk. We'll discuss this as we go along. Value creation, preservation, and realization we have discussed. Let us quickly do it. Value means any benefit created by the organization for different stakeholders. Creating value for customers, shareholders, employees. For shareholders, increasing stock price. For customers, increasing the availability of goods and services. So value creation means the creation of benefit. Value preservation means when the value of resources used is sustained and you can generate dividends for the shareholders in the future. You may keep on paying the interest and principal on time, meaning resources being available on a sustained basis. And value realization means when the benefits are actually transferred to shareholders, to customers, to employees, and all those stakeholders linked with the organization. So when benefits are transferred to the stakeholders. And the unfortunate situation that may arise is the value erosion. And what is value erosion? As the word suggests itself, value erosion means when the management's strategy, the management's course of action does not produce the expected results, or your management fails to perform the day-to-day tasks. These are also called the risk owners, the managers who are responsible for day-to-day tasks. The risk owners, when they fail to perform their day-to-day tasks, value is eroded. You won't have profits, you won't have dividends, you may find it hard to pay the interest and principal. So this is the value erosion, and we don't want that to happen. What we are doing, we are just doing the basic terms first well, so that when we study COSO, we know what we're doing. Then we have the board of directors. We know what they are, what they do. They are the one who oversee the ERM. They are the one who oversee the capabilities and the practices of risk management. They oversee, they don't have any operational role. Then we have the audit committee. We know what it does. It is the committee responsible to oversee the work of internal auditors as well as the external auditors. And it is required by laws like Sarbanes-Oxley Act 2020. 2001. Risk committee. This committee is responsible for overseeing the ERM. And risk committee, remember, if you might be a little confused. What about if board oversees the risk management? Risk committee is composed of the members from board of directors. Members from the board of directors, they are part of the risk committee that oversees the ERM. Even the members of board of directors, they are the part of audit committee, and they oversee the work of external and internal auditor. And again, Members of the board of directors, they will be the part of executive compensation committee. This committee is responsible for setting salaries of different executive staff. And again, from the same members of board of directors, we may have nomination committee that is responsible for selection of directors and executive for the organization. And then the next layer, management, they are totally different. They are not from board of directors. They are the one with the operational role. They are the one who have the overall responsibility of ERM, right? And is generally responsible for oversight. Oversight in a way, now there's a difference between this oversight by board and this oversight by the management. Because the actual action will be taken by the line managers, the risk owners, those who have the role to play on day-to-day basis, right? So they have the role of managing the risk, taking care of different risk vulnerabilities, and their work is overseen by the management, and this risk management is also overseen by the board of directors. The individuals directly responsible for risk are the risk owners. We'll discuss that as we go along. What we are doing COSO ERM framework, and we are discussing some complex terminology so that the model should make sense. Next concept here is the organizational biases. Sometimes your organization is more tilted in this direction than this direction. Sometimes management is more likely to take this direction and not this direction. This is called organizational biases. Tendencies to lean in a certain direction, which may be not good for the decision making, may be detriment to an open mind. So we should make decisions not based upon the biases, but rather based upon our fair assessment of the situations, rather than using our just preconceived concepts and prejudices that guide our decision making in one direction and not the other. Next, operating structures. Businesses can exist in different forms: sole proprietorship, partnership, public limited company, private limited company, public listed limited company, cooperatives, joint ventures, so on and so forth. So what the business structure is, this is what we need to consider also. Then legal structure, whether it's a incorporated business or whether it's just an unincorporated business like partnership and sole trader. Legal structure also matters. Then management structure, it will define reporting lines, different departmental heads, then many people working under these different departments, who reports to whom and what information is reported to whom, laterally, vertically, downward. This is for information and communication. Then next, internal factors. When you say internal factors, that would mean the level of judgment and autonomy allowed to personnel to take decisions, how much power or authority we have delegated to our subordinate staff for decision making. What are the standards and rules we use to evaluate their performance? And accordingly, based upon their performance, we reward them or punish them, right? Then external factors. Any legal requirements specifically related to your business, related to health and safety, regarding regulatory filing, and what are the expectations of regulators and society in large. Culture spectrum. Risk culture spectrum means some businesses will be very aggressive in taking risk, and some will be risk averse. We discussed that. Risk seeking, risk neutral, risk averse, very beginning in portfolio management. So culture spectrum means which range from risk averse to risk aggressive. Risk averse means avoiding risk because this utility of loss is greater than the utility of gain. And risk aggressiveness means risk seeking, whereby an investor in this domain would be more likely to see utility of gain as more favorable than this utility of loss. Discuss that again. Tone of the organization. How do the different parts of the organization work? How do they interact? How they perform their work? This is set at the tone at the top. Whatever the tone at the top is set by the management, it cascades and slides down the organization. Whatever you have here, strict compliance with the law. If it happens at the top, it will happen at the bottom. If there is lousiness at the top, carelessness at the top, you will see that happening at the down. This is called the tone of the organization. If we are more risk averse at the top, you will see the risk aversion at the bottom of the organization. Same true. So tone of the organization is set by the senior managers, and that reflects in everything we do within the organization, right? So some risk-averse management will set a tone that will cascade down the organization. Such an organization will have contingency plans, means the plans put in place in order to manage some unforeseen circumstances. And management that is more risk aggressive may have some totally opposite policies. Internal environment, the capital we own for production of goods and services, the people who will be engaged in these processes to produce goods and services, the processes through which the goods and services would be produced, your tasks, policies, procedures, SOPs, and the technology which transforms in different inputs to processes into output. They're all your internal environment. And external environment also affects external environment, involves your political environment in which you're operating. Many risks emerge from it. Economic environment, many risks emerge from economic environment. Social, technological, legal, and environmental. All these are external influences which may pose some risk for the business, and at the same time, which may pose some opportunities, means some probable benefits for the business. So they all emerge from external environment. Okay, next we have the dynamic risk. As the name suggests, the risk that is fluid. The risk that is just like interest rate risk is a dynamic risk. Why? Because sometimes it is less, sometimes more, sometimes very less. So because interest rates keep on changing, so the risk that keeps on changing is dynamic risk. Risk appetite, we've already seen the risk that we are willing to take. Compare it with the risk capacity. This is the risk we can take, and this is the risk we are willing to take. There's a difference between these. Then the next concept is impact, the key terminology. Impact means if the risk occurs, how deep will we be hit? Sometimes we are hit positively, sometimes we are hit negatively. So impact means how would we affect it? Impact is the result of effects of the risk. If risk materializes, how would it affect it? Impact can be positive if interest rates fall. It could be negative if they rise and we are heavily indebted. So a volatility interest rate can be positive and negative. Likelihood. Impact is how deeply we are hit. Likelihood is the possibility of the event occurring. We have discussed this earlier. Likelihood is the possibility that the event will occur, and likelihood may be expressed in percentages. Complexity. This term means the nature and the scope of the risk. Nature and the scope of the risk. What kind of risk are we facing, and to what extent it can affect different aspects of the organization. Interdependence of the risk. Then next term is velocity. As the name suggests, it's the speed with which the risk may affect the organization. How quickly it can affect the organization. Speed. Some risks, they affect organizations slowly. Maybe the increase in input price, it will take some time before your customers stop purchasing from you. Because if your input price go up, your cost of production goes up, you may pass on this price to your consumers, selling price goes up, and later on your demand starts falling. So it will take some time. Whereas the interest rate risk, immediately changes in interest rate will affect the value of your debts on the balance sheet. So the speed with which the risk affects the entity is called velocity. Persistence. For how long the risk affects the organization. If let's say, if the interest rates change and we are heavily indebted, we have taken so many loans from the bank on variable rates. So if the interest rate change, how long will it be effective, including the time it takes to entity to recover? So changing in interest rates, how long will it affect, and how much time will we take to recover from such a loss on changes in interest rate? Then adaptability. It is the entity's capacity to adjust and respond to risk. If we are facing a risk of interest rate volatility, it can hit us hardly. It can last for long. Have we made some alternative arrangements to manage interest rate futures, interest rate forwards, or to forward contracts with the bankers, or fixed interest rates? So it's an entity's capacity to adjust and respond to risk if it perceives. Recovery. It is the entity's capacity to return to the tolerance, and it is not basically the time as shown here. Persistence relates to time. Recovery means how quickly you can return to tolerance, is its capacity to return to tolerance to the point that is okay with the organization. Now, these are the risk responses we have already discussed in our previous discussions. Risk acceptance, the risk we are willing to take. Risk avoidance, avoiding risk, not engaging in activity that results in risks. Pursuit, deliberate seeking risk. This is called exploitation, risk exploitation. Risk reduction, sometimes called risk mitigation, and risk transfer and sharing. We discussed this. Each of these responses will involve some costs, some benefits. So we will see their costs, their benefits, and based upon their costs and benefits, we may decide which of these we might go with. It's not just the intuitive approach or just the haphazard decision. We need to analyze their cost of each decision and benefit of each decision, or in other words, cost of each response and benefit of each response, and then we go for that. Which of these risk responses should we go for? Next, how to reduce risk. We face different risks: interest rate risk, commodity risk, business risk, different type of risk discussed previously. So the way we can reduce risk are control activities, instituting a strong system of internal control, check and balance, that will reduce your risk. So these control activities can take 4 different views. First is the risk view, where you manage each risk one by one, each risk identified in each department. So this is called risk review. Minimal integration risks are identified and assessed, each departmental level, each activity level separately. When an organization matures, risk management system becomes more robust. The next stage is risk category view. We categorize risks, identify and assess risk, and categorize them based on operating structures. Financial risk, okay, which departments are affected? Business risk, operating risk, which departments are affected? So we categorize risk based on operating structures. When the organization matures enough, there will be a further comprehensive approach of taking risk profile view. That is the partial integration. What we do in this, risks are linked to the business objectives they affect. Here we just identify risk A, risk B, risk C. Okay, take this, avoid this, adopt, exploit this, reduce this, share this. In risk category view, we go one step ahead. We combine risk, we classify them, and then take accordingly the different steps. And then risk portfolio view, we link these risks categories into their impact of how they can affect the business objectives. Risks are linked to business objectives they affect. And finally, which is the most advanced form, we have integrated our risk management entirely at an organization level. This is called the portfolio view, called the full integration. What happens at this stage? This composite view of risks relate to entity-wide strategy and business objectives and their effect on entity performance. So we take risk management at an enterprise level rather than taking risks individually or categorizing them or linking them to the business strategy. We take the risk management process at an integrated level for the organization as a whole and see how it affects our business objectives. So gentlemen, these were the key terms just to help you understand what the COSO risk management is. Now we're going to start the actual COSO risk management, and these terms that we have learned so far, they will help us understand the concept better. Here it is. So here we go. The COSO ERM is an integrated approach that coordinate and integrate all of an organization risk management activity. Rather than taking risk management on a departmental level or an activity level, we take a comprehensive, composite, coordinated, integrated approach of risk management for the business as a whole, from end to end. That's why it's called the enterprise risk management. Business as a whole is taken under risk management. So why effective integration is necessary? When we take risk management at an organizational level, it will help us make better decisions because we are taking the decision while taking risk at enterprise level for the business as a whole. And as a result, when we take risk management at an enterprise level, it will enhance our performance. We will generate more returns on our investment. We will be able to reduce the risk in a way that will help us gain more resources, which will eventually lower our cost of running the business. Our cost of capital will fall. Fund providers will be willing to provide us money because we have a robust system of internal control put in place, right? Next, he has defined values. Value, all this we have discussed earlier. Let me explain this one by one. Value is created when benefits are obtained from resources, and value means benefits. Created when it is generated from resources, preserved when resources are used and sustained. Realized means the benefits are transferred to shareholders. Eroded means the management fails to perform day-to-day tasks, also called the risk owners, and management and strategy does not produce the result we were expecting. So this is value erosion, unlikely situation. This is the definition of COSO ERM, and whatever you're going to read in this definition, we have read in individual terminologies previously. So let us just define it in a broken form so you understand it well. ERM, it's a culture. We read what culture is: set of beliefs, behaviors, attitudes toward risk, capabilities. So the culture, capabilities, practices integrated with the strategy setting, how we achieve our objectives, and performance that organizations relies on to manage risk in creating, preserving, and realizing value. This is the definition of ERM as per the COSO model. Quickly, again, what is ERM? ERM, the culture, enterprise risk management, the culture, capabilities, and practices integrated with the strategy setting and performance that an organization rely on, depends on to manage risk in doing what? Eventual objective is creating value, creating benefit for the stakeholders, preserving value we just saw means when the resources use is sustained, and the realizing value means transferring the benefits to different stakeholders. That is the end objective. Transferring the benefits to the end or our different stakeholders, shareholders, customers, and so on and so forth. So that's how we define the ERM. Now let's move on to the studying the process of ERM. So ERM basically is an integrated approach, as we discussed. It provides value for all shareholders. So ERM is based on this assumption that every organization exists to provide value to stakeholders. That's the end objective, as we saw in the previous definition. Now, here it comes again, the risk profile. This is it. Let us now discuss from this point onward. This is our risk tolerance. This is our minimum performance. This is the maximum performance you're expecting. This is the risk we are willing to take. That's our risk appetite, as shown by this thick line here. Okay, now, this is the target risk we are willing to take. The target performance, not risk, is already defined. This is the risk appetite. This is our target performance. Our performance should fall within this narrow band. This narrow band is the tolerance limit. Now, your actual performance could be within this. If it is beyond the target, this is the target one. It means the management has done well. Or if it falls beyond below the line here, still it is within the what you call the tolerable limit. So it means your performance should fall within the narrow band, minimum to maximum, right? And why it has been said so? Because our risk tolerance is up to this point only, and the performance should fall only between these two upper and lower ends of the performance requirement. All right, next. As we discussed earlier, the board of directors, the senior most individuals in the organization, those who call the shots, they provide you the oversight of ERM culture, enterprise risk management culture. They provide the tone at the top, capabilities, practices, all these terms we have discussed earlier. So this board is then broken down into different committees to perform different aspects of the organization, like audit committee responsible for taking reports from internal, external auditor, risk committee overseeing the ERM, executive compensation committee, nomination committee. We have discussed all these. It's just now that the real things have started in ERM. So board provides the oversight to ERM capabilities and practices, and then these board members, they are represented in these committees through which the ERM is implemented. Next stage, below the board, we have management. Management that have the overall responsibility of ERM. Remember, board oversees, and management is take the overall responsibility of managing the ERM. They are responsible for day-to-day management of the risk. They are also called the risk owners. Mind the word, management that is responsible for day-to-day management, they are called the risk owners in their respective departments. Implementation of COSO development framework, this is their duty. And within the management structure, the CEO is at the top. Operating management, those who are responsible of the day-to-day affairs. CEO serve as a nucleus of the organization. CEO has the ultimate responsibility for the ERM and for the achievement of the organization objectives. So CEO is the ultimate person responsible for the ERM, and he's the one responsible to the board of directors. Many organizations that are sufficiently large, they have a specifically established department called the risk department, headed by a person called the chief risk officer. An organization may designate a risk officer. Larger organizations have a separate risk management department. This department is responsible for facilitating the risk management. They are not directly responsible. CEO is the one directly responsible, but this, just like different type of committees, we have audit committee, compensation committee, risk committee. This individual facilitates the risk management process across the entire organization, across the entire enterprise. Okay, now there are three lines of responsibilities, or you can say three lines of risk owners. Let me explain these one by one. First, second, and third. The first line consists of the principal risk owners, those who are responsible for day-to-day tasks. This is the first line of defense against risk. Second one are the business enabling functions, also called the supporting functions. They are compliance department, or maybe the legal department. And the last third line of defense are the internal auditors. First line of defense, day-to-day management responsible for day-to-day operations. Second, compliance department, legal department, also called the business enabling functions or supporting function. Also, risk management department also is a part of second line of defense. And lastly, the internal auditor. So if anything goes wrong, if the organization risk management system fails, they are the one primarily responsible. Second responsibility falls to compliance, legal, or risk management. And internal auditors are the one responsible the least out of these all three, because internal auditor's role is only to review ERM system and report accordingly. And next part, now this is all done. Next is the COSO framework visual model. This we'll discuss in the next class.